We'll first start with the motto song. I'll share my screen.
Thank you.
Friends, our speaker for the day is none other than CA Dr. Sanjeev Kumar Singhal who is the Vice Chairman of Accounting Standard Board and presently working under him as a special invitee is really a privilege along with MP Vijay Kumar sir. Sir is having 20 years of experience in as a chartered accountant. He is a BCom graduate from SRCC and a university topper. He has done his articleship from AF Ferguson and has done the PhD in international finance from FMS Delhi. He has got various achievements and has been working as a chairman of Sustainability Accounting Standard Board ICI. His partner from SR Batley and Company. He has around 14 books in his name. He has received various awards like CA Professional Achiever Award 2014 for outstanding contribution to the industry. He has been the faculty for NIRC Best Faculty Award. He has been Vice President Finance at Cyber Media, then worked as Executive Vice President Finance at Religare, and Vice President at Jubilant Life Science, and now he is working as a partner in SR Batley Boy. He has contributions to profession as he is a government nominee at NACAS and contributed towards resolving industry and professional interest issues. He was a special invitee in the CARO group set up by MCA. He represented India at World Accounting Forum, Dubai, World Standard Setter Meet, London, and he has been working for last 2 decades for the accounting profession as a whole. I welcome him wholeheartedly on behalf of ACA Study Circle. I think he's there for the first time for our study circle, and we are really privileged to have him to start our session on accounting standards. Before he starts, I will request Ranjit ji and Devashita and Sushil Bhaiya to give their to speak on as a Central Council member. We recognize their presence. Ranjit Bhaiya.
Thank you, Vivek, for giving the opportunity, Anupji. And I welcome the Central Council member from Delhi, Sanjeev Bhai Singhal. And he's the Vice Chairman of the Accounting Standard Board, and he's the first chairman of the first board set up by the ICI, Sustainability Reporting Standard Board. And friends, I would like to inform you that India is the first country which has established this board this year, and Sanjeev Bhai is the chairman. Under his chairmanship, he has transformed this board in the sense that UN Sustainability Development Goal 17 has been given a target, and he's working on that. Social exchange he's working on it, and the way he's working, it's a very innovative board and innovative works he is doing. And seeing the potential of this board, and now the world body, other bodies are also considering, IFAC is also considering to frame this sustainability reporting standard board. So I must compliment Sanjeev Bhai, and he's also very actively, socially active as CA Parivar and donation and charity. So he's a gem of the person in the sense that academically and socially both way he's excellent. So I welcome Sanjeev Bhai in this Eastern region, Calcutta, for the first time to address the member of our region. So welcome to Sanjeev Bhai.
Debashish da? Debashish da, you can unmute yourself.
Yes, now you can hear me. Thank you,
Yes,
Vivek.
sir.
Yes, Ranjit, Sushil, and of course, Sanjeev Singhal, my council colleague, all three of them. If you want to personify academic inclination, then it has to be Sanjeev Singhal. It is my second year in the council with him, and I have seen the kind of love that he has for the academics. The love that he has for the academics, I have seen that. Vivek, can you hear me? Can you hear me, Vivek?
Yes,
Yes, sir.
Devashish
Yes,
sir.
sir.
Yes.
The
Yes,
love
sir.
that he has for academics, I have seen that. Ranjit was telling us about sustainability reporting standards board. When this board was set up this year, many felt that what will this board do, and what will be the future of this board. But under the leadership of Sanjeev Singhal, this board has become one of the most active boards of the Institute of Chartered Accountants of India. You have so many programs, you see, going on. I think he has a program tomorrow. So many programs. And then he has introduced this executive development programs, the certificate courses. And he is doing a fantastic work, with this board. We are trying to develop audit quality indicators. There also, Sanjeev Singhal's contribution is immense. He is also the vice chairman of the Accounting Standards Board. Please note, when Vivek was introducing him, he was saying that he is a partner of SR Butley Boy and Company. But in the Accounting Standards Board, I have always seen advocating the cause of small and medium enterprises. That is, you see how he is, how unique he is. It has been a pleasure and privilege of sharing the same council room with Sanjeev Singhal Bhai. And I'm sure those attending to this program will be enthralled listening to CA Sanjeev Singhal. With these words, I welcome Sanjeev Bhai to this program.
Thank you,
Sushil
Devashish
bhaiya.
sir.
Thank you, sir.
Sushil bhaiya. Unmute कर लीजिए.
Thank you, Vivek. My council colleague Devashish Da and Ranjit Bhai and Sanjeev Bhai also. Sanjeev Singhal, I think it is always privilege speaking in the last that most of the topics are covered. So about Sanjeev Bhai, everything has been spoken. But one thing I want to tell all of you, can see the background behind the Sanjeev Bhai. It is his library at the residence. And one day I was talking to him whether this book are for display only or he has read all this book. Then he was telling, no, I'm regularly referring all this book. So this is the introduction of the Sanjeev Bhai. And now I find Sanjeev Bhai is a Aam Aadmi ki Awaaz. Whenever any chartered accountant facing any problem in the council, Sanjeev Bhai will raise the issue about any member facing any problem. That I have noticed. Yesterday also he was mentioning in the exam meeting only. We are had the meeting regarding the exam from 21st of November. Sanjeev Bhai has mentioned categorically whatever expenses we have to bear, we will bear, but we want safe and proper exam. No problems should arise to any of the participant even. He was even talking about the insurance of all the examinees. You can understand how concerned he about all the members and any participant of the exam department. We the coordinator, observer, invigilator, examiners, all. And regarding substance, his board, everything has been discussed, that the accounting standard and substantiality board we have discussed. We are definitely pleased to see you, Sanjeev Bhai, in e-mode. We wish to have you soon in Calcutta to hear you in person. Thank you.
Thank you, Sushil bhaiya. Just to add, Sanjeev sir is also very instrumental in doing the IFRS session in ASB. We keep on discussing this, and nearly 2,000 students have been trained in IFRS in this lockdown. So that has been very instrumental from Sanjeev sir. Over to you, Sanjeev sir.
Thank you so much, Vivek Bhai. Uh, I have no words, to express my sincere gratitude to what three of my elder brother in the council spoke about my board and me. Ranjit Bhai, followed by Devashish Dada, followed by Sushil Bhai, and it was Devashish Dada who wanted me to speak here. And I can tell you that few years ago, not few, now it is 9 years ago, I came to the Views Exchange CP Study Circle. So I remember that. And I can tell you these three council colleagues, they've spoken so high about me. But the way these three are making contribution, Ranjit Bhai did a fantastic job in Udin. We call him Udin Ranjit Agarwal. More than 1 crore UDINs are being generated in a year. And now UDIN is being followed by everyone, whether it is Central Board of Direct Taxes, whether it is Central Board of Excise and Custom, which is basically GST, Sushil Bhai ka area, maybe CBEC word ना हो कुछ और हो, so my apologies to him. मुझे डायरेक्ट टैक्स और जीएसटी बिल्कुल नहीं आता, ये मैं आपको बता दूं. And then the way Ranjit Bhai worked on the code of ethics, splendid job in it. Devashish Dada, the kind of meticulous work which he did for non-audit services and for responding to the MCA consultation paper, and the way he's leading the board of studies, that is amazing. This was one of my dream that one day the students will be trained by the ICI faculty rather than by coaching classes. So coaching classes are also welcome, but only thing is that in Delhi people pay up to 24,000 rupees per subject. That is very painful, and Dada has made it free of cost. And with more than 50 lakh hits, last count, what I know, I'm sure it would be much more than that. So that's a tremendous service to the profession, because if our students are quality students, then obviously the quality of our profession will go up. And the way Dada Devashish Dada is also leading the Center for Audit Quality Maturity Model. The first draft itself that he presented was amazing. It is his beauty, that's the quality that the first draft itself will come fully prepared and start the discussion from there. Sushil Bhai is doing a pioneering job in GST. He's a GST expert, so along with Rajendra Bhai, and last time also he did a splendid job. Very soft-spoken person, and I can tell you these are the three gems in the council which I joined only last year. I can wish and I can pray that the next vice president is from Eastern region. So that is, and it is sincerely, I can pray. All council members are equal. I can tell you, all council colleagues are equal. But the way these three gentlemen, three council colleagues, my elder brother have worked is amazing. With this now,
आमीन सर,
I
आमीन.
pardon.
आमीन मतलब आपकी बात लग जाए.
So, so to Anup ji, to Mohit ji, to Ashwini ji, Sushil ji, Ghanshyam ji, and of course Vivek ji. So thanks for inviting me here. I've been allotted four standards. These standards are 1, 2, 9, and 10. I'll be talking about the commonly observed errors in these standards. I'll also see if technology helps. Then I'll also be sharing my screen. Uh, and I can tell you at times I really wonder that do we really need the accounting standards seminars at this point of time. But what I found is yes, it is required, and this is what when Devashish Dada said that I'm leading this simplification of accounting standards. So God willing, if the council approves, we will have a much simplified standards for the non-corporate entities. For corporate entities, obviously it is not possible, but for the non-corporate entities, for small and mid-sized non-corporate entities, we certainly like to have the simplified accounting standard, for which one outreach program we did in the eastern region itself, and in the national region also. Devashish Dada was there as one of the panelists. So I'll be talking about these four standards, and believe me, Institute has published a book on commonly observed errors. And I tried making PowerPoint slides of that entire book. It ended up having 961 slides, with each case being presented into two slides, in one the issue and second the observation. But even if you merge them, you will have 480 slides. And this is the third volume. This is the third volume. So we can imagine the number of errors we are observing in the accounting standards, which the AS1 was issued in 1981. It is 39 years and still we find errors. So that's really painful, but we need to pull up our socks and then really see that because Devashish Dada, Sushil Bhai are in the disciplinary directorate also. So they will decide the fate of the member when a non-compliance with these accounting standards is there. And more often than not, we will not have much option. I mean, probably either to issue a warning or maybe some stricter penalties. But actually, these errors are avoidable. And now the Financial Reporting Review Board is also doing a 2-day webcast on the same. So we will be discussing these 4 standards. AS1, let me tell you, is the cornerstone standard. That's the basic standard, which tells about the disclosure of accounting policies. And accounting policies are necessary to understand. Accounting policies are necessary to understand the whole financial statements, because if the accounting policies are not submitted, then obviously one will not be able to understand the financial statements as well. So I'll share my screen and I'll send this presentation to the CP study circle as well, uh, so that all of you can refer. uh, Vivek, if I can ask you, is my
Visible.
screen visible?
Yeah,
Okay,
visible.
great. And my voice is also audible properly?
Perfect, sir.
Okay, great. So these are the commonly observed non-compliances in accounting standard. And Vivek, since I'm sharing my screen, I'll not be able to see the questions. Maybe after each standard, you can pose the questions to me. So like I'm covering 4 standards. So after each standard slides are over, you can ask me if any questions have been posted by the honorable members.
Sure, sir.
Okay. Starting with the AS1, let me tell you that 77% of the non-compliances relate to para 24, and then we have 14% for para 11, and then 7% and 2% for para 25 and para 17. And I'll be talking about these commonly observed non-compliances. First one, so in the case of a company, it was noted. So on the left hand side is the problem statement, and on the right hand side is what was the observation of the Financial Reporting Review Board. So it was observed that in case of a company, income from leasing business was shown as income from operations. Uh, so there is nothing wrong if it's a leasing business. But the company was in the business of setting up or operating the industrial infrastructure and not in the business of leasing. And company was also engaged in related activities involving leasing and providing services connected with computer software and data processing. So the observation of the Financial Reporting Review Board was that leasing is only a secondary business. So this was an incidental activity for the company. And if it's an incidental activity, actually it should not be called as income from operation, because that is not the primary business. The primary business is setting up and operating the industrial infrastructure. And hence, it was felt what I was saying, that paragraph 24 has seen the maximum non-compliances, that it is not in accordance with the spirit of para 24 of AS1. Next, it was observed in many companies that accounting policies relating to impairment of assets, which is covered by AS28, intangible, which is AS26, deferred taxes AS22, subsidies is 12, and gratuities AS15. They were stated as follows. Impairment losses, if any, on fixed assets are recognized in accordance with AS28 impairment of assets and charged to profit and loss account. Now, someone can say, what is wrong in it? Well, because you are mentioning that these are recognized in accordance with AS28. But What happens, suppose, in the accounting policy, if someone was to write that financial statement have been prepared in accordance with the Schedule 3 and the applicable accounting standard starting from AS1 to AS29. This will not give any meaningful information to the user of the financial statement. So यूजर को क्या देना चाहिए कि आपने impairment losses कैसे recognize करने हैं, किस point पे recognize करने हैं, value news कैसे निकालते हैं, recoverable amount क्या होता है. So that kind of an accounting policy should be stated. Vivek, if you can tell me whether I should use a mix of Hindi or English or only English.
Sir, as per your comfort, no issue.
No, I am fine with both because there could be some members who may not understand Hindi.
Yes,
So
sir.
just,
There are certain members who are from south of India. So
fine.
if you can prefer.
Sure, fine. Then similarly for intangible assets, AS26, it was mentioned that intangible assets are recognized and accounted at cost in accordance with AS26. Now again, AS26 is a very detailed standard. In accounting policy, the recognition criteria should have been mentioned, that when will you recognize, when it's an identifiable asset, when you control it, and when future economic benefits are associated. Similarly, cost will mean what? Cost will mean the purchase price, or it will mean the incidental expenses, etc. It will mean the overheads. So suppose an ERP is being implemented, so what all will be included in the cost? So that should have been specified. Then it says deferred tax asset and liability has been provided for in the books of account as per AS22. There are many financial statements which I've seen. First of all, they will name AS22 as deferred taxes. No. Friends, if you look at the title of AS22, it is accounting for taxes on income. So it is not deferred tax. Yes, it largely deals with deferred tax, but the title is not the same. Secondly, the standard talks about reasonable certainty, virtual certainty. When should deferred tax liability be recognized? When should deferred tax asset should be recognized?
Sir, you are not audible, sir. We have lost the audio. Let me see. Yes, Vinodji, we have lost his audio. So waiting for him to join from the audio. Pramod Bhaiya, please connect him and inform him.
Okay.
Pramod Bhaiya.
Pramod Bhaiya is talking to him. Pramod Mudra ji is talking to him.
Okay. Friends, we have lost the audio of the speaker. We are connecting to him and then we can get the audio. We are not able to hear you and there's some network issue, I suppose. No, we are not able to hear you. You can leave and join again. Your screen is also freezed. Okay. When the speaker is leaving and joining again, the system got crashed. So 1 minute he will be joining. Yeah, Sanjeev, you can unmute yourself and share the screen also. You are the co-host now.
Yeah. Okay. Are you able to hear me now?
Perfect, sir. Perfect.
My apologies. Technology, has its own limitations also.
No issue.
Okay. So I don't know up to, no, sorry, this is not the PPT. So can you tell me, Vivek, on which slide it got disconnected?
We got disconnected in the first slide itself where we're discussing the impairment policy and all.
Oh my God.
And we were trying to connect, but because you were in the phone, maybe was in silent. Over here only.
And I was receiving a call from PK Mundraji,
Yeah.
but I was not sure that. Okay. Oh my God. I'll repeat from the next slide. If it happens again, you can drop me a message or WhatsApp. I'll keep it open. So my apologies that I got disconnected on
No
that
issue.
slide itself, and then okay. So I kept my WhatsApp on. Okay. So let me take this example on the fixed assets again. It says tangible fixed assets are stated at cost, less accumulated depreciation and impairment loss pending. Cost comprises the purchase price, borrowing costs if calculation criteria are met, and any attributable cost of bringing the asset
Yeah, Sanjeev, you can unmute yourself and start. संजीव भी आपका ऑडियो नहीं आ रहा है.
उनको व्हाट्सएप करना पड़ेगा, वो व्हाट्सएप के लिए बोले थे.
नहीं, मैं बात कर ली हूँ अभी. He has joined.
Only.
It's cracking.
Are you able to?
It shows your network is very low. Yeah, now we can see you, but it shows your network is very low.
Are you able to hear me, Vivek ji?
Yeah, बोलिए. You do one thing. I'll share the screen from my side. You are muted, भैया.
Other instrument.
Friends, he's joining from another system. Just now we got a call. He's joining from another system.
Yeah. Vivek ji, are you able to hear me now?
Perfect, भैया. Perfect.
Okay. So I joined from a different device. Let us hope that this time, it works. So are you able to see the screen now?
Yes.
Okay. विवेक जी, ऑन अ लाइटर नोट, 3 सीनियर काउंसिल कुलीग होंगे तो जूनियर वाले की आवाज तो बंद ही हो जाएगी ना.
Very well said, sir. Very well said.
चलिए. सो ये एग्जाम्पल जो है, वेरी इंटरेस्टिंग एग्जाम्पल. एक कंपनी ने लिखा दैट 92-93 से हमारी कोई मैन्युफैक्चरिंग एक्टिविटी नहीं है. So that is why we are not giving information on license capacity, installed capacity, actual production and quantitative detail. और जबकि P&L में रेवेन्यू आ रहा है, इस साल में भी रेवेन्यू आ रहा है और पिछले साल में भी रेवेन्यू आ रहा है. And in the notes to the account, someone is saying that we don't have any activity. So obviously in those cases, what is the choice? What is the choice before the Financial Reporting Review Board? But to issue an advisory or to refer it to the disciplinary directorate. So these kind of observations are also found. Then for MAT, so almost everyone recognizes MAT. कि MAT credit तो हो ही जाएगा. We will get the offset. But not recognizing that we need to disclose an accounting policy for MAT recognition. So there is a guidance note on MAT. under the AS framework, and under the Ind AS framework, this is a part of Ind AS 12, which is which is on income taxes, which also deals with deferred taxes. So that accounting policy should also be disclosed. And then it should be reasonably certain that we will be able to utilize MAT. Now, of course, MAT can be used for 15 years, I believe. Earlier it was 8 years. But then whether in 15 year also you will be able to utilize MAT, that also needs to be seen. And as an auditor, the position becomes very, very difficult. See, hota kya hai? If the going is good, तो सब कुछ ठीक है. पता चला ऑडिटर ने फाइनेंशियल स्टेटमेंट साइन किए और 3 महीने बाद कंपनी ने आईबीसी में फाइल कर दिया, बैंकरप्सी फाइल कर दी, या किसी और ने कर दिया. द फर्स्ट पर्सन हु इज कॉट इज द ऑडिटर. कि ऑडिटर क्या कर रहा था, मैनेजमेंट से कोई नहीं पूछता, बट ऑडिटर इज आस्क्ड दैट व्हाट द ऑडिटर वाज डूइंग, एंड दैट्स द आयरनी. And obviously this is impacting our profession adversely, and we all are in the council, so I'm not saying to my esteemed members that this is your responsibility. This is our responsibility to take it up with the regulators. But the way the regulators, particularly NFRA, is behaving, that's very, very scary, friends. And my advice is that the accounting standard and auditing standard should be followed in letter and spirit. If you look at some of the AQR reports which NAFRA has issued for the ILFS, very alarming. While we may say कि auditor was at fault, हो सकता है, मुझे नहीं पता auditor was at fault or not. But अगर आप उस रिपोर्ट को ये भी पढ़ेंगे और अपने आप से बेंचमार्क करेंगे ना, क्या हम इतने डॉक्यूमेंट भी बनाते हैं क्या, then we'll find यार ऑडिट ही छोड़ देना चाहिए. Situation is coming to that. So if we are doing audit, we have to comply with all accounting standard, with all auditing standards to the extent they are applicable. And that's why, I'm advocating that at least for the non-corporate entities, we should simplify the accounting standards. Then on the next point, on the foreign currency transactions, it says that any profit or loss arising on settlement or cancellation of other derivative contract is recognized as income or expense for the year. But let me tell you, friends, AS 11 allows for forward exchange contract, we can recognize mark-to-market profit as well as losses. But under the accounting standard framework for the other derivative contracts, we cannot recognize the profits. Under Ind AS, yes, you can recognize the profits, but not under the accounting standard framework. So that is why this policy was also considered as wrongly drafted, and even the accounting treatment was also wrong. And then we also found that the accounting policies are scattered at various places. Investment की policy कहीं दी है, income tax की कहीं दी है, property, plant and equipment की कहीं और दी है. So let people found out. But then our AS1 says that they should be given at one place. Interestingly, Ind AS1 ऐसा कुछ नहीं कहता. So Ind AS1 में आपके पास choice है that this could be scattered, which is an irony. But मैं खुद वाइस चेयरमैन हूँ अकाउंटिंग स्टैंडर्ड बोर्ड का, तो अगेन आई कांट ब्लेम इट ऑन द मेंबर्स. But the IS1 says that IS1 ऐसा कहीं नहीं लिखता that this should be at one place, but AS1 लिखता है, and I feel AS1 is better in this aspect as compared to Ind AS1. Then in case of certain companies, we found that revenue from operation comprises of income from the real estate projects, and then the other operating income. But then we need to see if the real estate project income itself is 95% of the total income. तो बाकी 5% को हमें other operating income लेना चाहिए या non-operating income लेना चाहिए. Many times there could be a thin line, but then there could be a case for showing them as the non-operating income. Then in case of a banking enterprise, this was noted that the particulars of the security purchased and sold under the repo or the reverse repo have been disclosed by way of a note to the financial statements. Again, if it is a material accounting policy, if it's a material amount, then it should not be by way of a note to the financial statement. Rather, they should be properly disclosed. So many times what I've seen is some of the not so important things, some of the not so important items are disclosed very prominently, but some of the not so important and the important items are being missed out. तो वो हमें नहीं करना चाहिए. That we should avoid. And there is a guidance even in respect of the profit and loss account. See, many times we club everything under miscellaneous expenses, and sometimes we give every possible expense. Both the extremes should be avoided. So Schedule 3 में एक principle दिया है. If your expense or income is more than 1% of the total income, suppose the income, and income means revenue, income does not mean profit. हालांकि in the common parlance we consider income as profit कि मेरे पास क्या आया. बट अगर 100 करोड़ रुपए का रेवेन्यू है तो उसमें लिखा है कि 1 करोड़ से ऊपर का कोई भी एक्सपेंस है या 1 करोड़ रुपए से ऊपर की कोई भी इनकम है तो उसको हमें सेपरेटली डिस्क्लोज करना है और उसको हमें मिसलेनियस इनकम या मिसलेनियस एक्सपेंस के अंडर क्लब नहीं करना है. बट मेनी टाइम्स दिस इज नॉट बीइंग फॉलोड. सो वी शुड इंश्योर कि जो फाइनेंशियल स्टेटमेंट हम साइन करें उसमें वो फॉलो हो. सो then moving on. Now in case of certain companies, revenue recognition में क्या लिखा था देखिए. Turnover includes sale of services and service tax adjusted for discount. अब सुशील भाई यहाँ पर हैं. Service tax जिसको आप GST के नाम से जानते हैं. Service tax is a tax collected on behalf of the government. So service tax मेरा revenue नहीं है. It's only a pass through, and hence it should not be added to the revenue. Excise duty, the situation is different. And why it is different? Although excise duty is also ultimately deposited to the government, but the difference is that excise duty is a duty on manufacture. Yani ki if you produce the goods, then you are liable to pay the duty even if you don't sell the goods. Yes, as an administrative measure, what is done is that maybe the excise duty is deposited at the time of removal of goods from factory. And we may also say, up to excise duty hoti nahi hai. This is not relevant. No, excise duty is still there. On petrol, there is excise duty. On liquor, there is excise duty. So excise duty is added to the revenue and then subtracted from revenue itself. Gross or net alag-alag dikhate hain. But in case of service tax, sales tax, VAT, GST, etc., these are not added to the revenue, and these are also not shown as an expense. Now, there is a difference when we talk about the ICDS. ICDS 2 says that you have to show the closing stock in inclusive method. Inclusive method means you have to add the GST or VAT or sales tax, whatever it is. Whereas accounting standard 2 will say that you don't have to add if it's a tax collected on behalf of the government. So to that extent, you will need to show a reconciliation in Form 3CD and under ICDS 2, and that disclosure also you have to show in the adjustments which are there. But yes, it will generally not have an impact on the profit or loss. Hence, the impact on profit or loss will be nil, but you have to state this fact in the notes, and you also have to show this in the reconciliation. Tax audit ka season, so that's why you should keep that in mind. Then another point was that income from sale of electricity generated by windmills and rental income from immovable properties are recognized on accrual basis. Now, again, accrual basis is fine, but then we should say that these are recognized when the risk and rewards are transferred to the buyer. So those things we should mention. And, another was all income and expenditure item having a material bearing on the financial statement are recognized on an accrual basis. Very, very vague policy. This policy makes actually no sense. किसी user को इससे कुछ नहीं पता चलेगा कि what the management is trying to say. So hence, we should be cautious as an auditor. And if we are helping the firm or the company to make the accounts, then we should be careful while drafting. In fact, Institute is working on a project on the on providing an audit tool to all the practicing members, whereby they will be able to document their work, they'll be able to apply the data analytics, and we'll also try to give the model financial statement which will help the members. This we have discussed, and then let us okay. Accounting policy on employee benefits was given like liability for gratuity and leave encashment are provided on the basis of annual actuarial valuation at the year end and the management estimates for the interim period, keeping in view of the last actuarial valuation. No. AS 15 provides detailed guidelines that, when and how these estimates are to be done, how these are to be measured. So it also talks about a concept of defined contribution plan and the defined benefit plan, and in what circumstances it should be recognized and how it should be recognized. So those policies should be given. And then now let us talk about AS2. We have spent a lot of time on AS1, and that was also partly because of the technological disruptions. So para 5, which talks about inventory valuation on lower of cost or net realizable value, has about 45% of the non-compliances, and 27% are on para 26, and then rest of the non-compliances are spread over the various paragraphs. Now, let me take you through some of the non-compliances. An inventory, आपके ज़्यादातर clients में inventory is material. Unless it's a client engaged in providing these services, inventory is a very, very material amount. Some of the policies of inventory valuation says that the accounting policies, the stock of cards are valued at cost and on FIFO basis and include all applicable overheads in bringing the inventory to their present condition and the location. Work in progress is valued at cost. And then the second policy says that inventories are measured at cost. Cost is determined on weighted average basis. Work in progress is valued at the direct raw material cost and appropriate cost of completed process. Raw materials are valued at average cost. Raw material at bonded warehouse stores, spares, consumables, packing material, etc. are valued at cost, and finished goods are valued at cost or NRV, whichever is lower. And raw material stores and spares and stock in process are valued at the weighted average cost. Now, let me tell you that what is the observation or what is the issue. So in all these cases, the accounting policies, we can't say that inventories have been valued at cost or average cost. We should say inventories are valued at lower of cost and net realizable value. And we should also say that net realizable value is arrived at by deducting the expenses necessary to incur the sale from the estimated realizable value. And then we should also say that cost is arrived at by what method? FIFO method or weighted average method. Nowhere LIFO is allowed. And then weighted average also, if we can say whether it's a moving weighted average or a simple weighted average, etc., that also we should mention. Another important point is with relates to the absorption of the overheads. Manufacturing overheads are of two types: variable overheads and fixed overheads. Variable overheads are absorbed on the basis of actual capacity, but fixed overheads are to be absorbed on the basis of normal capacity. Let us take an example of COVID-19. Now, in March, we all know that 22nd March, Janta curfew was imposed. And from 24th March, there was a nationwide lockdown. So companies who are not in the essential sector, they lost production for 8 or 9 days in March, and for almost 1.5 to 2 months in Q1, which was from April to June. Suppose a company estimates that they will be able to make 1,20,000 units per year, means 10,000 units per month. And suppose their overheads are 1 crore 20 lakhs. Fixed manufacturing overheads are 1 crore 20 lakhs. It means 100 rupees per unit on an average is the fixed overhead absorption rate. If in April and May the factory was closed, it means 20,000 units they were not able to produce. If they were not able to produce 20,000 units, then 20 lakh rupees of overheads they will not be able to absorb if the rate is 100. Now there are two possibilities. You divide 1 crore 20 lakh by the actual production, which is 1 crore, which is 1 lakh. So it comes to 120 rupees per unit. And the other option is that this overhead on this production of 2 months, you charge it to P&L. Now the standard very clearly says that fixed overheads are to be absorbed on the basis of normal capacity. So ये जो 2 महीने में प्रोडक्शन नहीं हुआ ना, इसके कारण बाकी जो आइटम्स हैं उस पे लोडिंग इंक्रीज नहीं की जा सकती है. And this 20 lakhs will have to be taken to the P&L. Please do not allow it to be added. Please do not allow it to be added into the cost of the inventories. That should not be allowed in any case at all. Then, one more interesting point in this is that is there a situation when you may not write down the raw material even if their net realizable value has fallen? So para 24 of AS2 says that if the raw material ultimately will not be sold, it will be used in the production of the finished goods. So para 24 says if the raw material is to be used in the production of finished goods and those finished goods are expected to be sold at or above cost, means suppose finished goods का cost है 100 rupees including this cost of raw material, और finished goods का sale होगा 110 पे 120 पे, it means ultimately company will not lose the money, ultimately company will not sell it below cost. So then it says in that case that raw material should be stated at cost and not at lower of cost and net realizable value. So this also should be kept in mind. So these are the observations which I spoke overall. And then inventory में एक चीज और बहुत important है जो हमने कोविड के टाइम पे realize की. It is there every year, but it was more prominent under COVID. If on 24th of March, nationwide lockdown was there and goods were not essential category goods, then obviously the goods cannot move. If the goods cannot move, आपका agreement customer से X factory भी हो सकता है, or it could also be CIF. It could be door delivery. अगर X factory है तो no problem, you recognize the revenue. But if it is CIF and the trucks were not allowed to move, there is no way that you can recognize this revenue. क्योंकि जब goods पहुंचे ही नहीं customer के पास, तो आप recognize कैसे करेंगे? So companies should have reversed the sales made during this period which have not reached to the customer and added those sales back to the closing stock at cost or lower of at cost or net realizable value, whichever is lower. Now, एक चीज और ध्यान रखनी थी that if these are perishable goods or semi-perishable goods, then we also have to keep in mind that these may not have any realizable value left now, or maybe the realizable value is much lower. So that also should have been done. Now, many people have asked many questions in these webinars because, ICI issued the accounting and auditing guidance. So now if someone has recognized the revenue, then people started saying argument. Are you able to hear me, Vivek? I received a message disconnected.
No, sir, perfect.
Okay, I just received actually WhatsApp saying disconnected. Okay, fine. I'll ignore. Okay. So, लोगों ने कहा कि उसने अपने फैक्ट्री का शटर थोड़ा सा ऊपर किया और वहां से सेल कर दिया. फिर किसी ने कहा वो गुड्स अपने घर पे ले आया था और वहां से सेल कर दिया. If under lockdown nothing was allowed to be moved, as an auditor will you accept that argument कि फैक्ट्री का शटर उठाया और दे दिया? कितने लोगों को दे दिया? कि सारा का सारा माल बेच दिया? So as an auditor, we will not accept such kind of arguments, and we must safeguard our interest, because every type of financial reporting takes place. There are people who have used this as an advantage, saying जो कुछ write off करना है अभी COVID period में write off कर दो. So as an auditor, obviously we cannot accept those things. Then excise duty we have discussed. Yeah, एक बहुत ही कॉमन एरर है सर, बहुत ही कॉमन एरर है. हम लोग लिखते हैं कि the inventory is as certified and valued by management. क्या लिखते हैं? Inventory is in management is in the process of reconciliation of inventory. अरे भाई अगर ऐसा लिखते हैं, and if the inventory is material, as an auditor, how will I not qualify the report? If I'm saying inventory is as certified and valued by management, और ऐसा trade receivable के लिए भी करते हैं, that customer balances are subject to reconciliation. Actually, it has no meaning. ऐसे जितने cases आएंगे, these will be marked as common error, and these will also be referred to the disciplinary if the amounts are material. Because as an auditor, either you are satisfied or you are not satisfied. If you are satisfied, then this note should not be there. If you are not satisfied, then there should be a qualification. There is no third way for these things. Yes, amount should be material. There is no doubt about it. And materiality is actually fundamental to the entire process of accounting and auditing. But materiality also can't be 5% of revenue or 10% of revenue. There are various parameters for revenue materiality, but materiality will in no case be more than 1 to 2% of the revenue. Now, in some cases, accounting policy on inventory valuation has not been disclosed at all. So obviously that's an omission, and care should be taken that these omissions are not there. Then, in case of a company, it was noticed that the short-term provisions include a provision towards old inventory, and the amount is significant. Well, if that is the situation, actually it should be reduced from inventory itself. There should be a provision for slow-moving and obsolete inventory, and this should be reduced from the value of inventory. कई बार हम क्या करते हैं, ऐसा इसलिए नहीं करते कि डीपी इफेक्ट हो जाएगी, ड्राइंग पावर इफेक्ट हो जाएगी, but that is not valid. And I can tell you under CARO, under the new CARO, तो जिसने भी 5 करोड़ से ऊपर का वर्किंग कैपिटल लिमिट लिया है ना, the auditor will have to give in the CARO report whether the quarterly stock and debtor statement submitted to the bank by the company are in line with the books of accounts or not. So that is very, very important. Then in one of the case, it was noted that, land has been shown as an inventory. Earlier it was shown as fixed asset and it's been valued at lower of cost and NRV, whichever is lower. Well, yes, land can be an inventory. Absolutely no doubt about it. If it's a real estate, then it can be an inventory. But जो note में लिखा था ना, company entered into an arrangement with X Limited for the purpose of development of the commercial cum residential project in Mumbai. In accordance with the agreement, company has to contribute its land and X Limited is required to incur all the development expense of the project with the understanding to share the ownership of the project in an agreed ratio. Construction or development of the project was stayed by the Honorable Supreme Court, stating that the same land can be used for the purpose of agro-industry or any other permissible industry under the current regulations. Management is exploring its possibility to use the land in question as per the permissible regulations. So now the purpose for which actually you want to use it has been stayed by the Supreme Court. So the question is, when the management is exploring the possibility to use the land as per the current regulation, then if you look at the definition of inventory, it says inventories are the asset which can be sold, which are held for sale in the ordinary course of business. Now in this case, Supreme Court has stated, so where is the question of these being held for sale in the ordinary course of business. So hence classification as an inventory need to be thought again. In one more case, it was mentioned that the import of materials is accounted on receipt thereof at the factory. Again, it is incorrect. The reason being that companies are required to maintain their accounts on accrual basis. So if the ownership has been transferred, whether FOB or CIF, whatever basis, but once the ownership has been transferred, the company is recognized, the company is required to recognize that inventory in its books and not on the receipt basis. Then in some of the policies, it was mentioned that note on inventory and stores and spares have been disclosed on the net basis. Again, if it is disclosed on a net basis, then the nature of adjustment should have been shown. So this was about AS2. So Vivek ji, if there are any questions on AS1 and AS2, I can take up those questions before I proceed to AS9 and AS10.
Sir, because of the paucity of time, we can complete the 4 standards.
Fine. I understand. I know, because we actually ended up wasting some time. So AS9, let me tell you, revenue is the most important item. And there are many such cases. I'll share 1 or 2 interesting case studies with you. See, for example, gross and net, ये एक बहुत बड़ा इशू है. एक एडवर्टाइजिंग एजेंसी ने एक कंपनी से टाई अप किया, and the company gave them advertisement worth 1 crore rupees, and 10% was the agency commission to the advertising agency. एडवर्टाइजमेंट एजेंसी क्या करेगी? ये 1 करोड़ रुपीस न्यूज़पेपर को देगी या टीवी को देगी और 10% उसको कमीशन मिलेगा. अब फॉर द एडवर्टाइजिंग एजेंसी द क्वेश्चन इज द रेवेन्यू इज 1 करोड़ और रेवेन्यू इज 10 lakhs. 1 करोड़ का चेक क्लाइंट ने दिया एडवर्टाइजिंग एजेंसीज को. Now if you really look, the advertising agency is acting as a principal or as an agent. What is more important is to identify this. In this case, actually, the advertising agency is acting as an agent and not as a principal. An agent should recognize revenue only on net basis and not on gross basis. So actually, the advertisement agency should recognize only 10 lakh rupees and not 1 crore rupees. This is first error. Second, at what point of time they should recognize 10 lakhs? When they receive the check or when the advertisement appears in the newspaper. So if they are accounting for their revenue on an accrual, or if they're maintaining their accounts on an accrual basis, which if it's a company, it will have to be. But if it's a partnership firm or a proprietorship firm, then there is a choice. But if you're maintaining your books on an accrual basis, then you can recognize this 10 lakh as your revenue only when the advertisement appears in the newspaper and not before that. एक और एग्जांपल लेते हैं AS9 पे, very interesting. Suppose there is a distillery and there is another company which holds a brand. Suppose XYZ liquor का brand है, but XYZ does not have a distillery. So it approaches PQR, a distillery, saying that you manufacture liquor for me and I'll reimburse all manufacturing expenses plus give you a manufacturing margin of 5% or 10%. All the receipts are in the name of PQR. All the expenses are in the name of PQR. The excise duty is in the name of the PQR. So question is whether PQR should recognize full revenue or only the 10% margin on the manufacturing expenses. So there is an expert advisory opinion on this, which says that in this case, actually the distillery is acting only as an agent because they are not carrying the inventory risk. They are not carrying the price risk. So they should recognize only and only the commission amount and not the entire sale and purchase, even though excise duty has been deposited by them, even though all payments have been made by them, doesn't matter. Actually, they should recognize only and only their share of the margin. Then moving on to another case. Accounting policy of revenue recognition states that revenue from online education services, अब तो online बहुत कुछ है, is recognized upon receipt of subscription fee, otherwise apportioned over the subscription period. So receipt of subscription fee in case of non-refundable money. सारी जगह ही लिखते हैं ना कि non-refundable. आजकल वेदांतु हो, बायजूस हो, they'll say 1 lakh rupees, 2 lakh rupees per year. Until last year, they were charging 20,000 rupees also. So whatever is their pricing, that is fine. But say, for example, for engineering classes, say, for example, my son has joined Vidya Mandir classes. Someone will join Akash. Someone will join Fitzy. And they'll say money once given is not refundable. Fine, not refundable, agreed. But can you recognize this as your revenue? Answer is no. Even if it is not refundable, till the time you provide your services to the children, that is, when you are teaching over a period of time, only then you can recognize this revenue, and otherwise you cannot recognize this revenue. Next situation. In case of a company, it was noted that the company has recognized as income the entire cost of garments destroyed by fire under other operating income, stock loss claim, based on filing of the insurance claim. And with regard to partially damaged stocks, the related inventory has been valued at net realizable value, ascertained on the basis of claim filed with the insurance company. Insurance claim against loss of fixed assets has also been recognized based on the claim filed with the insurance company, and the note further says that the said income has been recognized as per AS9. Now, there are multiple questions in this statement. One is whether it's an operating income or not. Secondly, whether the revenue can be recognized on the basis of claim filing. Well, certainly revenue cannot be recognized on the basis of filing the claim itself. Revenue should be recognized on the basis of whether there's a reasonable certainty that the claim will be accepted. And secondly, insurance claim is certainly not an operating income. The business of the company is not to earn money through insurance claim, but from sale of its goods and services. So certainly this income is to be recognized, but the question is, should it be the operating revenue or not? In my view, it should not be operating revenue. And then it should be recognized only when it is not unreasonable to expect the ultimate collection, and not before that. Then moving on, in case of couple of companies, following accounting policies were there: that revenue in the nature of advisory services rendered towards finalization of power purchase agreements, CDM services, load management, etc. is recognized when the fees are determined under the terms of respective agreements. Galat hai. We should, if we are using, either you use a proportionate completion method or a completed contract method. But when the fee will be determined, is no way to recognize the revenue. If you want to follow a completed contract method under AS, under Ind AS, that is not allowed. Completed contract में contract खत्म होने के बाद recognize करेंगे. Percentage completion में आप percentage base पे लेंगे. You can take an estimated amount of fee. वो change होगा. You can true up the estimates, and that will be treated as a change in an accounting estimates. Moving on, this excise duty we have already discussed. Then on dividend, it says dividend is accounted as and when received. No, ये तो cash basis हो गया. AS9 says dividend should be recognized when the right to receive dividend has been established. So if it's been approved in the AGM, then at that point of time, you should recognize the dividend. And some cases says, again, it's on the receipt basis. Now, one more policy, very interesting, says income and expenditure are recognized on accrual basis, except dividend on share and unit of mutual fund, which are recognized on cash basis. Again, that is not correct. Moving on. It says revenue or income is recognized when no significant uncertainty as to the measurability or collectability exists. And revenue and income and cost or expenditure are accounted for on accrual basis. And sales are accounted for on dispatch of the products. So actually, just writing accrual basis and sales accounted for and dispatch of product are not right. We should write about the transfer of the risk and reward, and that should be the basis of recognition of revenue. Then the many observations which were there, we have discussed regarding duties and taxes, excise duty, etc. And excise duty have been observed number of times. That observation. Then one relates to the revenue recognition again. It says profit on sale of investment is recognized as income in the period in which the investment is sold or disposed of. But here revenue नहीं है sir. Investment income जो है, आपका अगर business है तो then it is revenue. But otherwise it is non-operating income. Sale of investment is non-operating income and not an operating income. And moving on to the last standard for the discussion allotted to me on fixed assets. But now the standard name has changed. It is property, plant and equipment, and even depreciation is combined into this. Fixed assets में बहुत सारे issues होते हैं. And many times the issue is whether the expenditure was allowed to be capitalized or not. देखिए इनकम टैक्स वाला चाहेगा आप हर एक्सपेंडिचर को कैपिटलाइज कर दें और ऑडिटर चाहेगा आप हर एक्सपेंडिचर को चार्ज ऑफ कर दें. Management may have a different objective, but then we should see that the accounting is as per AS10. Accounting policy of one of the companies states that underutilized or idle assets are recorded at estimated realizable value. And estimated assets held for disposal are stated at their estimated net realizable value. Now, actually, underutilized asset should be tested for impairment. Underutilized and idle asset, and they should not be simply stated at the estimated realizable value. Similarly, asset held for disposal should be stated at the lower of the cost. Cost means the depreciated cost and the net realizable value, because net realizable value ज़्यादा भी हो सकती है. Maybe the undepreciated amount is only 1 lakh, whereas the net realizable value is 10 lakhs. But then it cannot be shown at a value which is more than the depreciated cost. And similarly, impairment testing की जगह simply ऐसे नहीं कर सकते, उसको estimated realizable value पे दिखा दें. Then a very old note, land and building at certain locations were revalued on 1st October 1982. Gross depreciation for the year includes depreciation on revalued asset charged against revaluation reserve. Sir, allowed ही नहीं है. आप depreciation को revaluation reserve से charge नहीं कर सकते, आपको उसको P&L में ही charge करना पड़ेगा. Then one accounting policy states that fixed assets are stated at cost oblique professional valuation. ये कोई word नहीं होता professional valuation AS10 में. Less accumulated depreciation. Cost includes freight, installation costs, duties and taxes, interest on specific borrowing utilized for financing the qualifying fixed assets and other incidental expenses. So there are many errors in this accounting policy. Professional valuation is no meaning. It should be cost or revalued amount. And then interest on specific borrowing, it should be borrowing cost, because interest on general borrowing also may be required to be capitalized if AS16 conditions are satisfied. Then another note which appears is that company revalued its freehold land, building and plant and machinery. These revaluation resulted in net increase in the value of asset by so much, which was credited to the revaluation reserve. But actually, if that happens, then there is so much other information which needs to be given in case of revaluation, which was not given. So that was treated as non-compliance. Then in one more case, it was noted that a significant amount has been shown as addition to site and land development during the year under review, but no depreciation has been charged. So when it's a site and land development, then you need to see that in more often than not, this will require to be depreciated as well, because this is not equivalent to land. So these are the common errors which we have observed in these 4 standards as per the publication of the institute. Of course, more errors are taking place in say AS1, AS2, etc. AS9 generally people still get away with the vague policies. AS10 में तो बहुत सारी errors अभी आगे आएंगी because AS10 was revised in 2016 and these statements are being reviewed. थोड़ा सा backlog है financial reporting. Review board के publications में रहता है थोड़ा सा time, 1-2 साल का gap रहता है. But otherwise, you know, even after these publications, the instances of errors actually are not reducing. We must take care as professionals that these errors are minimized. So with this, Vivek ji, if there are any questions in the balanced time of few minutes, which is left as per your schedule, I can take up those questions.
Friends, if you have any question, kindly write in the chat box or you can raise your hand. In the meantime, sir, we can have 1 or 2 questions from my side. One is the question in regard to the mall maintenance or real estate, what we see, where the electricity is given by the mall owners to the store owners, and it is netted off with the electricity. But actually, those electricity charges are being charged not on the actual basis, but on the allocation basis. And it may have the profit element also, which is also in the case of the resident association, which are there in the, for various big resident association, the amount is also big. So we think the netting off should not be allowed. But for safeguarding their interest for income tax or GST audit purpose, many a time we see they are doing netting off, whether that is correct or not. And similarly, for the reimbursements which are being done or collections which are being made from employee for the residency given at the factory level, or various perquisites which are given and reimbursed by the employee at the token cost like the canteen expense and all. So whether netting off is allowed with the expense or revenue should be shown separately. That can be a small question, and which is frequently in various balance sheets, small balance sheets.
Sure. Very good question, Vivek ji. As far as the reimbursements are concerned, suppose canteen actual expenditure company incurs is 100 and recovers 40 from the employees. Right? So first of all, salary will be on a gross basis. Salary में हम ये नहीं कह सकते 40 rupees हम less दिखाएंगे. Right? Now, as far as my expense is concerned, so if I'm saying salary on a gross basis, then subsidy actually I'm giving is of 60 rupees and 40 rupees employee is paying. So what I'm doing is my expense is actually 60, 40 is borne by the employee. So 60 should come as my expense, which is the subsidy and not the entire amount of payment. See क्या है? Suppose एक employee की salary 20,000 रुपया है और उसने कैंटीन का महीने में 2,000 रुपया या 40 रुपए के हिसाब से 1,000 रुपया दिया, तो हमने एम्प्लॉय को 19,000 रुपया दिया और 1,000 रुपये उसके बिहाफ पे कैंटीन वाले को दे दिया. एंड सपोज इसका एक्चुअल कॉस्ट इसके फूड का 5,000 रुपए था. So while the company will make a payment of 5,000 to the contractor, to the canteen contractor, but 2,000 is actually paid on behalf of the employee. So 3,000 is the expenditure of the company and 2,000 is actually a deduction from the employee account. So the subsidy amount or the staff welfare amount should be 3,000. Similarly, for the electricity expenditure, if there are sub-meters which are installed, and if the landlord is paying one bill and taking a reimbursement from the people occupying those premises, then the actual electricity expenditure of the landlord is only the balance amount. But yes, if there is no sub-meters and on an estimated basis in the maintenance they are charging it, then you know it is the actual expenditure, actual income they will show gross, and the actual bills which they have paid they will show as an expenses. Then netting off will not be allowed.
Thank you, Sanjeev ji. Any other questions anyone is having, or sir was so crystal clear as always that there is no doubt or point of question as such?
नहीं विवेक जी, मुझे लगता है कि शुरू में डिस्कनेक्शन काफी हुआ, तो वैसे see I only see two reasons when questions are not there. One, when what you mentioned everything is clear, and one when nothing is clear. So everything clear तो कभी होता नहीं है. So you know there could be the other way around.
If depreciation will be charged on laptop purchase in March, but not issued to employee for use till year end. If the question is if depreciation will be charged on laptop purchase in March,
it should not be charged. It should not be charged
because put to use has happened.
it should not be charged in income tax because these are not put to use.
Correct.
But in accounting, it is available for use.
Yeah.
So if these were available for use, then yes, in accounting, we will charge the depreciation. In income tax, we will not charge the depreciation.
So one more question, sir. For the allocation or for the commercial, as per AS10, when the asset is ready to be intended to be used as per the requirement of the management, as management intended to use, the allocation or the capitalization of the expenses. In that, many a time there is a question, suppose a new company is there and it is having a overhead at the head office level. So whether the company can capitalize everything or the admin overhead or the head office expense should be charged to PL, because in those cases, always a new company will have a loss. Say if it's a asset intensive company which will be ready to be used commercially for 3 or 4 years, like a cement industry, edible oil industry, anything as such. So whether that should be charged to PL, and if it is charged to PL, the question again comes of the going concern and the reportings which has increased in SA 570, etc. So whether all this admin expense, head office expense should be charged to PL or allowed to be capitalized if there is only one factory, or in the real estate if there is only one project?
No. So only the expenditure which is directly related to factory can be capitalized, and all other expenditure has to be charged off to P&L, irrespective of whether there will be a going concern issue or whatever. So it cannot be capitalized. So it has to strictly go as per AS10 only.
Perfect, perfect. Ashwini ji, request to please share the presentation will be
Yeah,
shared.
which I will. You can just drop me a test mail and I'll email it to you.
Sure, sir. Anyone having any other question? Thanks a lot. Thanks a lot, sir. I will request the chairman of the Audit Accounts Committee to give formal vote of thanks.
Before that, I would like to express my sincere apologies for the technological glitch, and also the fact that some of you were trying to reach me on the phone, including our honorable council member Sushil Bhai, but I was not able to pick up the call, and they were trying to reach me actually saying that voice is not clear. And particularly, but when I saw SK Agarwal, then Kolkata was there. Then I thought something is wrong. That a call coming at that point of time. So something is, so my apologies. So technology has an advantage and technology has a disadvantage as well. But it was really nice on your part to give me a chance to come and share the views, and particularly when 3 of my council colleagues are there, and Sushil Bhai is still very, very actively listening. And I'm sure he's going to ask me more questions when I meet him in Delhi. But really, it was indeed a pleasure. It was overwhelming to see the entire Eastern India Regional Council members being there. And a very beautiful background of his photograph was also visible, Sushil Bhai. So thanks to all the council colleagues and to the CP Study Circle for inviting me, and to the members for a very, very patient hearing. If I've done any errors, I seek my apologies. Thank you. Thank you very much.
We would like to say that we will not will now make you a regular affair at ACA Study Circle. And today morning only I was discussing with our Anup ji. We will be planning again a series of session on Indias as well for many Indias listeners over here, and you will be our first choice all the time. Because I asked Mundra to get connected with you and get you as a speaker, because knowing you from ESB and regularly listening to you, we know how much hard work has gone in last 2 decades in accounting standards and Indias which you have given, and we'll look forward as a study circle again to have you on regular basis and get enlightened. And as per technology part is there, this is the best part of technology, or COVID-19 has acted as a catalyst that the ASB has given certificate to around 2,000 people. Ongoing 17 batches are there. On the other hand, we have a session in Calcutta. Speaker is from Delhi. Our next speaker is from Bangalore, and only technology can make it possible that we have pan-India programs organized. Over to Pramod ji, our chairman of the Accounting Standard Audit and Accounting Standard Committee of ACAE. Pramod ji.
Yeah, thank you, Vivek, for giving me an opportunity to offer a present vote of thanks for Sri Dr. Sanjeev Singhal ji. Sanjeev Singhal ji has really touched upon all the critical aspects of and most of the common errors which is being executed by all chartered accountants. And in fact, his presentation has been so thorough and so, I can say, to the point that it will compel all of us, most of us, to go through our notes to the accounts which we are giving in our audit report, in the audited balance sheet, and have a relook on the matters, on the factors where we are committing the mistakes. By touching all these four important accounting standards through common errors, he has also touched upon all the important aspects of all the accounting standards in detail. How the valuation has to be done, what kind of notes which we should give, and what common errors which we are making. And undoubtedly, we, as of now, we all are in the process of this copy and paste. If any error is there in 1 year, it gets continued in every year. We are used to cut and paste this thing. But then his deliberation has been very, very thorough, and I'm very sure that all the delegates here will definitely go and have a relook in their notes for the accounts and make the necessary corrections. Because the way he was talking that our audit reports and audited accounts are reviewed by the this board, review board, it's a high time we should have a relook on all the mistakes which we are committing. With this, I will request all the delegates here to offer him a very hearty vote of thanks with a huge round of applause. And I think this is the first time I think I am listening to Sri Singhal Sahab, and we will have more and more opportunity of listening from him, because he has been very, very thorough and very particular, very meticulous. Thank you, Singhal Sahab, for your nice, very, very nice deliberations. Thank you.
Thank you very much, sir. Thank you. I take your leave. Thank you.
Over to you.
Thank you, Sanjeev. Friends, our next speaker is there, CA Sanjay Sharma from Bangalore. He's the member of the institute. He is the member of the institute and has experience of 18 years working in accounting and auditing field for leading audit of large corporate listed entities in India, United States, and United Kingdom. He specializes in IFRS, Ind AS, and accounting standards, and has authored various articles on accounting and auditing, regulatory compliance, etc. Sanjay sir is having experience. Sanjay sir's experience spans across various sectors, including the technology, IT, ITS companies, industrial markets, private equity, venture capital, and consumer market. He has been advising leading companies as they went global and transitioned to international reporting, compliance, and corporate governance norms. And without further delay, let's have the complete complete focus of our speaker, Sanjay sir. Sanjay ji, you are a co-host. You can unmute yourself. He is unmuted. And you can start your deliberation. Whether you will be sharing the presentation from your screen, or I should share from my end.
You can do it, Vivek ji, no problem.
Sure.
बिल्कुल अनुरोध सब गया कि नहीं टीचर होगी फोन कर बिल्कुल आया को नहीं
Pramod ji, unmute yourself, please.
Vivek ji, I can control the slides, right?
You can control the no. You have, for controlling the slides from your end, you have to share your screen.
Okay, let me share it then.
Yeah.
Is it visible now?
It's visible. You can just go for the
slideshow
mode.
No problem.
Thank you, Sanjay ji, for accepting our invitation at a short notice and taking this journey forward for us. Over to you, Sanjay ji.
Okay. First of all, good evening, honorable members. It's my pleasure to be here today. I was requested by CA Mohit Buteria, who I know him for last almost 17, 18 years. He called me last week and he said if I can take the session. And it's my privilege to be attending this first one actually as a speaker. I've been doing this session in South India in Bangalore particularly, but never got a chance to speak in a forum in eastern part of the country where I actually belong to. I mean, I'm also from Calcutta in that sense. So, but thank you so much for giving me this opportunity. I'm going to cover 4 accounting standards today: cash flow statement under accounting standard 3, contingencies and events occurring after the balance sheet date, which is accounting standard 4, accounting standard 5 on net profit and loss for the period and prior period item and account changes in accounting policies, and the last one, related parties. As we know, the theme of our presentation today is to primarily deal with matters which are typically found as an error when people go through their audited accounts, and see what implication it has, what are the typical errors that we see. The flow of my presentation is primarily around building case studies. So you will see a lot of case studies covering a lot of errors that we potentially see in many of the accounts that we go through. So I'll move on to the slides as we kind of proceed. The first one on accounting standard 3. First 2 slides I'll touch upon what are the key objectives of this standard, not to get into too much theory, but as we know that the objective is primarily to present how much is the cash and cash equivalent movement during the year, identifying what are the elements of cash and cash equivalent or the cash flow, which is primarily around operating activities, financing activities, and investing activities. It is obviously applicable for all the companies except for a company which is a 1-person company or a smaller dormant company. Don't want to get into applicability too much. Again, there are two methods under which cash flows are presented, primarily direct method and indirect method. In both methods, at least the investing and the financing cash flows doesn't change. They remain the same, but the operating cash flow is determined very, very differently under both methods. Again, not jumping into too much theory, I will jump onto the first case study. Again, explaining a very important point that companies actually make as an error in their cash flow statement. So if I look at, this is a company which is a company C, which is a non-financial company, and the company has a holding company A and a subsidiary B. Company C has then received a dividend of 300 from B, which is a subsidiary, and in turn has paid dividend to company A, which is my holding company. Now in the profit and loss statement, it has an interest income coming from fixed deposit of about 50, and it has also paid an interest on loan that it has taken for about 100. The question that really is, how should company disclose interest and dividend paid and received in the cash flow statement? Now, typically people try to paint it with the same brush to say whatever treatment I do for interest income, I will do it for interest expense. And similarly, whatever treatment I do for dividend income, I will do same treatment for dividend payment. But that's the error that people make. So if I were to really summarize, what is the real crux of what should be done? So basically, since it is a non-financial enterprise, any interest paid in the nature of cash flow from the financing activity. Basically, you are saying that you have a loan against which you are paying an interest. Therefore, there's a financing activity for which you have to disclose in the cash flow. Similarly, interest received is because you've invested that money into the fixed deposit and therefore should be shown as an investing activities. People tend to kind of, because they make error in presenting income and expense net sometimes in the P&L, they end up into making a similar blunder in the cash flow statement also. Similarly, with respect to dividend, it was viewed that the cash outflow due to dividend paid should be shown as a cash flow from financing activity, because there is a shareholder who's invested in you. In that sense, they have financed your company and you are paying dividend as a financing outflow back to them. Similarly, the dividend income should be shown as an income investing activity because it is arising out of funds that you've invested into, which is paying off dividend to you. So again, common mistakes we see is that both are netted off and they are not presented the way accounting standard 3 requires you to present. Moving on to the second one, company C builds a plant and pays off cash of about 1,000, which includes rupees 50 of capitalized interest. The question really is, how would C disclose the interest paid in the cash flow statement? Again, if you look at, C should present the interest paid of 50 as a cash outflow from financing activity, because what you have essentially paid is an interest on the money that you borrowed to build the plant. Now, it does not matter whether that interest has got capitalized or not capitalized. The remaining 950 is included in the investing activity because that's something you paid it to build your plant. This is again consistent to the requirement to classify this different composition in a single transaction. So the total amount of interest paid is disclosed in the statement of cash flow, regardless of whether the expense has been recognized in the P&L or has been capitalized as a borrowing cost under accounting standard 16. Now the company should choose an accounting policy to be consistently applied to the cash flows related to the capitalized interest, either as a cash flow from investing activity, if the other cash flows are also kind of reflected as investing activities, and consistently with the interest cash flow that are not capitalized. So you need to just make sure that you follow a consistent accounting policy for interest payment. Coming to case study 3, company Z obtains a loan in a foreign currency on May 15. The cash proceeds from the loan are exchanged into Z's functional currency on the same day. So you kind of take a foreign currency borrowing and you convert it into your functional currency. There are no other transaction in 2020. How should company Z disclose the related transaction in the cash flow statement? So really there are a couple of issues here. One is there is a cash inflow that is coming in because of the loan, which is there. Then there is also a unrealized gain or loss because you are translating your foreign currency borrowing into a year-end rate, which is what you are supposed to kind of cover. So if you really look at from a response perspective, in the statement of cash flow for 2020, Z will present the unrealized difference relating to the loan in a foreign currency as a single non-cash item within the operating cash flow. Now, the typical error that we have seen is if you look at here, what is the amount of unrealized gain or loss? It is essentially the foreign currency borrowing converted into the year-end rate will get you an unrealized gain or loss. Many a time we have seen that this unrealized gain or loss is not disclosed separately in the cash flow statement, which is a requirement of AS3. And therefore, it just gets subsumed within the profit and loss account without being shown separately. Now, that is an error we have seen in many accounts, which one needs to be careful of. The second thing is the loan obtained. That obviously is a financing inflow that has to be shown separately under the financing activities. Moving on to case study 4, company Z's cash and bank balances include balances in foreign currency on 31st March 2020. How should the company disclose the related transaction in a cash flow statement? Now, the real issue here is that if you have a foreign currency cash balance, you have dollars in your books, or you have, let's say, pounds in your books, you are supposed to disclose under accounting standard 3 a reconciliation when you give it at the bottom of the cash flow. You know, how much is the foreign currency exchange effect on the cash and cash equivalent? Many a times we have seen that that disclosure is omitted, and that causes a restatement or a mention by the auditor in the audit report. So that's the response to that. It has to be shown as a reconciliation in the cash and cash equivalent at the bottom of the cash flow. This example actually illustrates the effect of foreign exchange gain or loss on the balances of individual entities' cash and cash equivalent presentation. So if you really look at the summary of transaction, there is a cash and cash equivalent held in the foreign currency of $100, and the exchange rate is 1:1. So maybe this is an Indian rupee balance in that sense. Then you have receipt from customers which are in foreign currencies, which you converted at a rate of 1.5:1 per rupee. Then you have payments to supplier, again in foreign currency, you have at a particular spot rate, which you have accounted for. And then you have a foreign currency balance of 150, which is translated as at the year-end exchange rate of 2:1, and you draw this. And in the balance sheet, if you look at the share capital is obviously at a historical cost, and a retained earning of about 200 in the functional currency, but and therefore cash is about 300. Now let's look at what are the typical questions that one would see. So from a cash flow perspective, you have a net profit of 200. You again have to show this unrealized gain or loss separately, which again, like I mentioned earlier, is being omitted by many companies. Then you have cash and cash equivalent at the beginning of the year, and this exchange fluctuation on cash and cash equivalent because of a foreign currency cash held needs to be shown as a separate line item at the end when you are giving a reconciliation between opening cash and cash equivalent to closing cash and cash equivalent. So this is a blunder which you have seen many people do make on this. Coming on to another issue which we have seen practically in many accounts, company A obtains a loan of 2,000 during the reporting period and uses the proceeds to repay another loan of 2,000. The question really is, many a times companies tend to disclose this as a net number without any shareholder or any users of the financial statement get to know that there is a loan inflow and loan outflow that has happened. Accounting standard requires you to present this as a gross item within the financing activity. So you take a loan under the financing activity, you show that as a separate line item, and a repayment of the loan has to also shown as a separate line item. Now there is a leeway under the accounting standard to say if there are multiple transactions. So for example, if you keep investing into fixed deposit and they keep giving you interest multiple times in a year, you don't have to show every single inflow and outflow in the cash flow. You can actually show a net number if you have multiple transactions and happening throughout the year. So that's a flexibility given. But if it is a loan one-off taken and given, that has to be shown separately for a reader to understand what is really the substance of the transaction. Case study 6 actually talks about a company which has leases 5 floors in an office. The lease payments are about $1 million per year for the current year based on the amortization schedule. $995K is for reducing the lease liability, and about $5,000 is the interest portion. The error that we see commonly done by clients is entire 100,000 or 1 million is accounted for as a lease liability without segregating how much is the interest outflow in that. So clearly, if there's a time value factor and over a period of time you are paying interest on the lease liability, then that has to be shown separately in the cash flow statement. Couple of other points that we have seen, which people do make mistakes in the cash flow. Many a times the loan that has been given by a holding company to a subsidiary, we have seen mixed practices. Companies sometimes show this as a operating cash flow, sometimes they show it a financing cash flow, sometimes they show it as an investing cash flow. Now really, there is no one right answer for this. Depending on what the nature of this loan has been given, is it for the purpose of day-to-day operations of the company, or is it for the purpose of expanding the operations of the company, and so on and so forth? We need to determine what is the right classification and then present it in one of those 3 different cash flows that are presented. Second issue that we have seen is that fixed asset read with the note on other income that during the year certain fixed assets were sold. Now if you look at the consistency of the financial statement, in one side you see that there is a fixed asset that has been sold, but on the other hand, when you disclose the amount of cash invested to purchase fixed asset, you don't adjust the cash proceeds from the sale of assets, and it gets subsumed within the operating cash flow. That's again an error we have seen, maybe material in some cases, may not be material, but that has to be shown separately, and it has to be adjusted in the investing cash flow, because to that extent, your cash outflow for purchase of fixed asset stands reduced. But we've seen people not doing that adjustment. Again, there are certain non-cash related item which has to be disclosed separately, whether it is provision for doubtful debt or advances written off, so on and so forth, which has to be shown out and adjusted back in the operating cash flow. Many of the times companies don't do that separate disclosure, thereby not giving a right picture of what is the operating cash flows. One of the other issues that we have seen is with respect to contingent consideration. I'm not sure how many people are familiar with this term, but in a business combination, many a times when you do an acquisition, you end up paying certain cash consideration upfront, and there are certain earnout or deferred consideration that are linked to future performance. Now, obviously, on day one, when you do an accounting, you will record a liability because you have a probability of paying this amount. But when the actual cash outflow happens, it may happen after 1 year, 2 year, 3 year. The question really is that cash flow an investing activity or a financing activity, or is that something else? So there is no clear-cut guidance under the accounting standards, but internationally what we have seen is that if you had recorded a liability to the tune of, let's say, $100, which is what your original amount envisaged was, if you end up paying $100, which is originally recorded, to that extent it goes into an operating, because essentially you are saying the company that you've acquired is also part of my business, and therefore it's a regular payout from a business perspective. However, if you end up paying more than the originally recorded amount, let's say you recorded $100, but you ended up paying $110, then one could say that the 10 could be an element of financing which you had to do because of a deferred consideration, and there's a time value factor associated with that contingent consideration. So again, it has to be looked at from a substance of the transaction perspective, and then evaluated whether the presentation in the cash flow is right or wrong. One other typical error that we see again is when you do an acquisition of a company, you obviously take over assets and liabilities and some cash which might be sitting in the acquired business. So when you really present it in your cash flow, you will obviously say net cash paid for acquiring a business X amount. But out of that, you're also receiving cash as part of that business. So essentially, you are supposed to disclose the net amount to say X amount paid for acquiring a business, net of so much of cash that is appearing in the books of the acquiring company. So these again are sometimes material, and companies tend to miss out these disclosures. Again, presentation of government grant in cash flow is a typical error we have seen. Depending on the nature of the government grant, whether it's a revenue grant or a capital grant, we need to present that in the cash flow. If it is a capital grant, then obviously it's an adjusting thing in the investing activity. If it is a revenue grant, then probably it will go under operating. One other mistake that we have seen in many accounts is companies just tend to take the consideration paid to acquire fixed asset as one line item in their investing cash flows. They don't adjust the capital creditor balance, which is sitting in opening and closing balance sheet. And similarly, advances for capital creditors, if you have given, you don't adjust that while presenting the investing cash flows for fixed asset. And the capital creditor movement and the advance given to capital creditors sometimes just simply go as a working capital change, which is not right. Therefore, you need to carve out to that extent amount from operating cash flows and present it into fixed assets acquisition. One very important disclosure which many companies tend to miss out, and so does auditors at times, is the non-cash transaction that needs to be disclosed. So, for example, if there are exchange of transactions that has happened, exchange of values that has happened, it has to be disclosed as a non-cash item within AS3. I will move on to accounting standard 4, primarily around contingencies and events occurring after the balance sheet date. Again, an old standard that has gone into a few amendments in the past, but we'll touch upon few critical errors that we have seen in the accounts and how have auditors kind of also overlooked at some of those. Again, I don't want to jump into slide number 16, which is more theoretical, and I will straight away jump on to the case studies on this. So this is with respect to checks which has been received from XYZ Marketing Services Private Limited, which were dishonored during the year. These are basically checks received from the customers. The company has initiated legal proceedings against the said party under Section 138 of the Negotiable Instrument Act. Management is confident of recovery of the dues, and hence no provision is required. Now, typically when you get into these situations, there will always be a pull and a push between auditors and the client, because client would say that I am very confident that we will recover this money, whereas auditors will tend to say that because the checks have been dishonored, you need to make a provision for that. The real issue is, what is the requirement of this disclosure in the financial statement for March 2020? Now, the point is, since the company has initiated the legal proceeding against the party, which clearly indicates that there's a possibility of an existence of a contingent loss, because if that was not the case, then company would have not initiated a legal proceedings, because there is the chance that you might not get this, and hence you have got into a litigation. The recovery of dues is doubtful, and hence, along with the nature of contingent loss, an estimate of the financial loss has to be disclosed. That is the requirement of accounting standard 4, to say you build an estimate and say how much could be a potential contingent loss arising out of this matter. Case study 2 again, there's a major fire that broke down and damaged the uninsured assets in the factory subsequent to the balance sheet date, i.e. 2nd of April 2020. the company cannot continue with its operation because that was the only plant they had, and there are no other assets or factories that they can run on. So basically, the whole operations of the companies are stuck and they cannot do any business. The question is, does it have any financial impact on the financial statement and anything on the auditor's report? Now, if you really look at, there are a couple of issues to be thought about, which many a times get missed out. If this is the only asset which has got damaged completely and there's no business of the company, then clearly going concern assumption will get impacted, and therefore management will have to prepare the account from a non-going concern perspective, and auditors will have to be comfortable that that's how the presentation has to be. So, and because there's a loss that has happened, you might have to also make that adjustment of that loss, given that it has occurred, and that has a bearing on the going concern issue. Coming to case study 3, the financial statement of XYZ for the year ended March 2019 were approved by the board of directors on 1st July 2019 and were signed by the auditors on the same date. The financial statements were issued on 10th of July 2019. During August 19, an investigation has been initiated against the company by a regulator in response to an allegation of fraud by management of the company involving embezzlement of funds and misappropriation of asset. The auditor has the knowledge of this investigation. Now, since this is an event occurring after the balance sheet date, and here in this case, the investigation has started only after the financial statements have been issued, what action should an auditor take is what we want to cover. Obviously, from a regulatory and governance point of view, they will have to notify about this to the management and those charged with governance, that the action will be taken to prevent future reliance on any audit report. Because you've already issued an audit report, you need to go and make that statement that this audit report cannot be relied upon because of something that has been identified and noticed subsequently. If despite notification, the management or those charged with governance do not take necessary steps to prevent reliance of the auditor's report, then action taken will depend on whether what are the auditor's legal rights and obligation. I really don't want to get into the Companies Act requirement of this, because we are more talking about accounting standard. But just as a concept, that because this has happened post the issuance of our report, what obligation it casts on the auditor to kind of assert the fact that this report cannot be relied upon because of significant matters. Now let's look at what are the other errors that we have seen typically, which companies make in as far as accounting standard 4 is considered. If there is a bankruptcy that has been identified subsequent to the reporting date, the question really is, will this be an adjusting or a non-adjusting event? Now, we all know that all of these bankruptcy, whether it's a Chapter 11 bankruptcy or otherwise, just don't happen overnight. Obviously, there are enough and more indicators during the journey of the bankruptcy that people will get to know. The financial performance of the company is not going good, or there are a lot of NPAs and so on and so forth, whatever the case may be. So while the event of bankruptcy or the declaration of bankruptcy could have happened post balance sheet, if the conditions were existing as of the balance sheet date, then this has to become an adjusting event. If there was nothing that was available for anyone to believe that there is indication as at the reporting date, then obviously it's a non-adjusting event and you need to make a disclosures, which many a times people tend to forget the differentiation between what really existed as at the balance sheet date and what actually arose subsequent to the balance sheet date. Again, this is something we keep seeing very often, breach of loan covenant after the year end. Now, again, this is more from a Schedule 3 presentation perspective, but if there is a breach of loan covenant, which has happened as at 31st March, because most of these loan covenants are always as at the balance sheet date. So if you have breached a loan covenant as at the balance sheet date, then obviously it's an adjusting event, because you need to factor that whether because of the breach of covenant, will my loan, which was non-current so far, becomes current because of breach. Now, subsequent to balance sheet date, if there is a breach of loan covenant, but if you are able to get a waiver from the counterparty, then you may continue to present this as a non-current issue in that sense, non-current loan. So again, we need to look at what is the point in time, the trigger happening for this to be called as an adjusting or a non-adjusting event. We've also seen that there's a reduction in the NRV, or the net realizable value of inventory, after the reporting date. Again, this happens typically when we are in a COVID situation also, as we know that many industries have got suffered because of this, and therefore the net realizable value subsequent to the balance sheet date has actually reduced for the same product that used to give you a 15, 20, 30% recovery of your cost. Now, clearly, if the net realizable value has gone down and the conditions were existing that because of COVID, you will not have a marketable market for selling these products, then you need to adjust your inventory as at the balance sheet date to reflect the decline in the value of inventory in that sense. Same thing may happen for your investments. If you are holding an investment and there is a downward trend of how market is shrinking, subsequent to balance sheet date, it has kind of crashed, then you need to see whether that condition existed on the balance sheet date or not, and therefore determine whether it is an adjusting event or a non-adjusting event. I will actually move on to AS5, which is on net profit or loss for the period, prior period item, and changes in the accounting policy. Typically, there's a concept of extraordinary item which is there under Accounting Standard 5, which requires separate disclosures in the profit and loss account. There is a concept of change in accounting policies which has to be applied. I'm not going to get into what is a change in accounting policy versus a change in accounting estimate. Prior period item is a concept which is existing under Indian GAAP, but when you look at Ind AS or IFRS, all of these gets into a restatement if these are really material. But under Indian GAAP, prior period items are disclosed separately on the face of the P&L, and that's the key distinction. We will see some examples of what can be a prior period item. Company M has a prior period income of 100, prior period expense of 200. Now, the typical error that we have seen in many accounts is that companies tend to disclose net prior period income as one line item. Now, if you really look at, if somebody was to present this net number of 100 as an expense, 200 minus 100, it would not give a real picture to the users of the financial statement as to what is the expense which was misstated and how much is the income that was understated. So what the standard requires that you need to disclose that separately in your profit and loss account. Obviously, materiality will play a big role in terms of whether the disclosures have to be netted off or not. But if the amounts are material, then the expectation is that it has to be shown separately. Many times we've also seen companies make a net presentation in the P&L, but refer it to a schedule where they can present the gross values for a reader to understand better as to what does this comprise of. Most importantly, which most companies miss out, is the nature of such income and expenses. They don't disclose it. They simply put a table to say, these are the 5 items of prior period and be done with it. Whereas that is not the intent of the standard. The standard setters expect that you explain the nature of these adjustments which are relating to prior period. Very rarely do we see that happening, but that's a thing which needs to be looked at carefully. Case study 2, company M has accounted for the following items of income and expenses that have been shown in the profit and loss account under the head, under the below the line item: provision for earlier year taxation, write back of bad debt, and sales tax due. Whether this treatment in the profit and loss account is appropriate or not. Now, typically, if you look at provision for earlier years taxation is an expense, whereas write back of debts of sales tax is an income, both of which should be included in the determination of net profit or loss for the period. However, if you kind of net this off, and we've seen this companies doing it, for various reasons. If you present it net, again, you're not giving the real picture of what those adjustments are, and it could result into a misstatement. Liability or reversal thereof is arising out of error or omission in the preparation of financial statement of one or more period, and therefore that write back has to be shown separately. Even under Companies Act, you are required to show this separately in your P&L. Company M has a policy relating to gratuity, that the gratuity liability has to be recognized on a payment basis until the previous year. However, during the year under review, the company has changed its accounting policy from a cash basis to an accrual basis. Now, many a times companies and even auditors for that matter miss out a distinction between a change in accounting policy versus change in estimate. As we know that a change in policy has to be retrospectively applied, whereas a change in accounting estimate can be done prospectively. Hence, the disclosure of such a change is mandatorily required. Many a time we've seen in accounts, these are very, very cryptic. People tend to, hide behind the bush and not disclose that something really has changed. Maybe it is also intended to not, bring it to the limelight and kind of bury something under the carpet. Auditors will also have to be careful in those situations that was it really that the company is trying to hide an error under the garbage or under the garb of, change in accounting policy. So we need to be careful as to why that accounting policy has changed. Is it something that company was not doing correctly in the past? And therefore, to correct that, they are taking the color of change in accounting policy. So that is something extremely, extremely crucial. And we as auditors and companies will also have to kind of be serious about it. Company M has miscellaneous income of 100, which is on account of surplus as a difference of price on cancellation of contract due to non-supply of CMO by various parties during the year end, and on account of any possible errors or records. The said surplus has been accounted for on the basis of disclosure by income made by the company under Section 132 of the Income Tax Act. Now, how should this be disclosed in the financial statement? Now, what is important is that the significant income has arisen due to price difference on cancellation of a contract and errors in the record. This income due to cancellation of contract is an income from ordinary activities. However, the income from errors in record is certainly a prior period. So one needs to really do the hair split when a company records a value as one line item, really to get into the details of that to say what element of this is really a prior period and what is in the ordinary course of business. If it is in the ordinary course of business, then obviously it just goes like a normal item in the profit and loss account. If it is income which is extraordinary and exceptional, that has to be disclosed separately and with an appropriate disclosure to say why this has arisen and what is the cause of recording it in the current year as opposed to recording it in the previous years. This is a very, very judgmental area. Companies will tend to defend some of these to say these were never prior period. I never had visibility or any indicators to say that I should have recorded it in the past. And therefore, a lot of auditor judgment will come into play, looking at evidences to support why something would have not been known to the company in the previous year. So again, a huge area of judgment which auditors will also have to be careful about. I'll talk about the related party standard. Related party, as you know, is a relationship which has ability to control or exercise significant influence over the financial and operating decisions. Both enterprises need to comply with the disclosure requirement. So which means the party who you're talking about and the other party both needs to kind of comply with the disclosure requirement. Control, as we know under Indian GAAP, is either an ownership or directly or indirectly of more than one half of the voting power. So simply it goes by the voting power that gives you the control. Obviously under international standards, voting power is not necessarily a condition or not necessarily the only condition to drive control. There can be many other indicators. We are only covering Indian accounting standards. So I'm not getting into international accounting standards in terms of how you can establish control. Then control over the composition of the board of directors and the governing body. Very, very important. How many number of board members are there and how many are your nominees will also determine whether you have the control or not. And a substantial interest in voting power combined with the power to direct financial and operating decision of the enterprise. Now, the third and the last bullet is important because it should be read together. It's not an or condition, but an and condition. The other concept under related party is significant influence. We have seen that significant influence can be through participation in financial and operating policy decisions, but not control. Significant influence can also be gained by share of ownership and statute or agreement. And third, assumed to exist in the case of the 20%. So there are certain rebuttable conditions to say if you are more than 20% invested and less than 51%, it is assumed that you will have a significant influence. Similarly, if it is less than 20%, it is assumed that you will not have a significant influence unless you rebut those assumptions. Again, the relationships that are covered from an accounting standard perspective is parent, subsidiary, fellow subsidiary, associate, equity accounted, investee, joint ventures, investors in respect of which the enterprise has an associate or a joint venture. I'm not going to get into too much theory on this, but quickly jumping on to case studies. If a parent owns, along with its subsidiary, more than 1/2 of the voting power in an enterprise, whether that enterprise will be considered as a related party of the parent. So if you look at the case study here, there is entity A, there's entity B, which is a subsidiary of A, and C, which is a equity investee of B. Now, clearly A also holds 15% in C, therefore the economic interest is about 39%. The question is, will C also be a related party for A? I think this should be simple, but we have seen people not able to catch this and therefore not disclose C many a times in their related party disclosures. The issue is not about also not disclosing it, but the fact that there is a control is sometimes missed out by disclosing that fact in the related party, that it has a control, directly or indirectly through one of its subsidiary. And sometimes they make an error to just say, because I have 15% stake, it could be only equity investee or just an investment. Looking at the case study 2, this is with respect to a consolidated financial statement of a group. Would that enterprise have significant influence over the subsidiary to be considered as a related party? Now, A has investment in B, B has some stake in C, definitely not a controlling stake. C also has an investment from X. Now, clearly X and A are not related. X is an independent party. The question really is, in the books of X, how do you disclose C? Obviously, C will be disclosed as a related party. But if you look at from A's books of account, A Limited neither controls nor is controlled by A. A neither exercises any, X neither exercises any significant influence over A, directly or indirectly, or it is not itself influenced by it. Therefore, in the consolidated financial statement of A, only transactions with C with X would needs to be disclosed, and not that between XA and XB. Okay, let's do some more practical errors that we've seen in respect of these case studies. The first one is A Limited and XYZ Inc. USA, both are wholly owned subsidiaries of a UK entity, PQL PLC. Should A disclose its relationship with XYZ even if no transactions have been undertaken with it? Now the issue is, what does the accounting standard says? That the parent relationship has to be disclosed irrespective whether you have any transaction or not. Whereas any other relationship, you don't have to disclose if you don't have a transaction. But we have seen many a time companies making very, very confusing disclosures. In many cases, wherever it is not required, also they end up disclosing it in the related party disclosures. So the answer is no. While the statement includes fellow subsidiaries as a related party, there is no existence of a control between them. Since no control exists between A Limited and XYZ Limited, no disclosure is required to be made by A if there are no transactions. Obviously, if there are transactions, then you need to disclose that in the financial statements. Okay, coming to case study 4, A Limited formed a wholly owned subsidiary B Limited. However, during the current year, there were no transactions with B Limited. Would A Limited be required to disclose B in a related party disclosure? Now, typically, people tend to also cover themselves by saying, I have anyway disclosed in many other places investment made in B subsidiary. In the cash flow, you will have anyway, right? So is there a need to really disclose? Because I have done the investment only in the part of the year. And companies don't tend to disclose it under related party disclosures. Because there is a control that exists, you are still required to disclose even if you don't have any transactions. But many a time we've seen related party disclosures miss this in totality. A Limited has given corporate guarantees to bank and financial institution for credit facilities extended to B, or personal guarantees given by the directors for the loans taken from banks. So B has taken loans and A is kind of giving a corporate guarantee or a guarantee to the bank on behalf of B. The question is, would A be required to disclose in its related party disclosures that the guarantee has been given? Now, again, this is typically we've seen in many recent cases that some of these guarantees and all are not disclosed by company, trying to hide it under the carpet, and which is why regulators are very concerned that these disclosures are not being presented. Any guarantees is a specific disclosure requirement under AS 18 and has to be disclosed. Item number H is what says about guarantees, and that's something we need to disclose. Coming to the next one, A Limited has disclosures of the nature of all transactions and the volume thereof, including balances outstanding as at the balance sheet date. However, the same is in the name of related parties with whom such transactions have been taking place, or balances are due from not been disclosed. Is this a correct disclosure? Absolutely no. You are required to give disclosures of not only the transaction, but also the balances as at the year end, which many a times we see companies tend to miss out. This is actually an interesting case that we've seen live in one of the company. Entity D is a related party of A, B, and C because each of A, B, and C hold 30, 30, and 40% in D. B and C provide services. Okay, the question really is, what all transactions are required to be disclosed? Now, if you look at entities A, B, and C are related parties of D. From a D's financial statement, A, B, and C are investors, so there is a relationship, but not necessarily related party to each other. Clearly, A, B, and C may be related. Just because A, B, and C have common investment doesn't mean that A and B and C are related to each other. So that's something one needs to be careful about and not kind of confuse the readers by putting unwanted disclosures. Coming to case study 6, a director, Mr. X of entity A, is also a director of entity B. He does not control either of the two entities. There are no other directors in common between entity A and entity B. Entity A has a trading relationship with B, which is at arm's length and all of that. And entity A and B, are they related or not? That's a question. Many a time we have seen that companies tend to disclose A and B as related party, but really there is no related party disclosure required because there's no correlation between entity A and B. Just because the director is a common director does not mean that through that common directorship, A and B becomes related. So one needs to be again careful. Don't go overboard and keep disclosing what is not required. Other errors that we have seen typically in a related party transaction is questions arise as to whether the transactions are disclosable where the parties are related only for part of the year. So for example, if you have a related party at the beginning of the year, but the related party relationship ceases to exist during the year. So as at the balance sheet date, that party does not continue to be a related party. We have seen many companies take a view that because that party is no more a related party, I don't need to give the disclosure because I'm giving disclosure as at the balance sheet date. The truth is that that's a wrong assumption because related party is a disclosure for the year as well as at the balance sheet date. So you cannot absolve yourself by saying that the related party relationship does not exist as at the balance sheet date. You still need to disclose the transactions that happened till the time the party was a related party. And you may not show any balance because that is no more a related party as at the balance sheet date. Now, one of the other misconceptions we've seen people take is that related parties disclosure standard is more to give disclosures of transactions entered during the year and the closing balances. And the interpretation that people take is the transaction during the year is primarily a profit and loss account related transaction, whether it's a sale transaction or a purchase transaction and so on and so forth. But what people tend to miss out is a very obvious transaction. It can be investments made, it can be dividend declared, it can be loans given. People will certainly disclose what is the closing balance of the loan. But loan taken, repaid, generally we have seen companies missing this out as a disclosure. So that is something we need to be careful as an auditors and even corporates to make sure that no related party transactions are missed out. The issue actually arises not only at the time of audit, but when companies have transactions with related party. From a transfer pricing perspective, when they do a 3CEB study, the TP auditor will also question to say your disclosures have been kind of missed out in the financial statement. So again, it is important that we kind of bring all the disclosures. We've also seen situations where related party disclosures are kind of netted off. Again, that is a wrong disclosure. Those are supposed to be presented gross and not netted off just to kind of show off a lower number of transactions. One other issue that we have seen typically in accounts is that any amount that is written back or written off for a related party is not disclosed. The view that companies tend to take is that because that is not really a transaction I'm entering with a related party, it's more like a one-sided entry. I decide to write back or I write off a related party balance. Therefore, I don't need to disclose. But that is not true. AS 18 also requires you to disclose any amount which is written back or written off has to be disclosed under AS 18. So I've covered the 4 standards with case studies. I'm happy to kind of take on questions. We have time another for 25-30 minutes. Any Q&A questions? I thought we should be making more interactive session. Vivek?
Vivek is not there.
Oh, Vivek is not there? Okay.
Anup?
Maybe we can open the session for people to have comments, questions.
Hello. Sir.
Yes.
I would like you to throw some light on adjusting events and non-adjusting events with relation to the accounting standards of events occurring after the balance sheet date. What are the adjusting events? What are the non-adjusting events? And how we should deal with this?
Sure. So typically the standard says that if you are having an event that has occurred subsequent to balance sheet date, but the underlying or the undercurrent of that event was available or indicative as at the balance sheet date, then you technically tend to believe that those would be something which existed as at the balance sheet date and subsequent confirmed that the event has kind of fructified. If you have that kind of a situation, then those will be called as an adjusting event, which would mean that your amounts recorded as at the balance sheet date will have to be adjusted for the effects of those events. Whether it is a bankruptcy of the customer that we talked about as an example, if we knew that the customer is actually running out of cash, there are enough and more indicators that he's not able to maintain his cash flows. All of that existed as at the balance sheet date. But subsequent to balance sheet date, he files for Chapter 11 bankruptcy. That itself is an indication that we should, adjust our balances recoverable from the customer as an adjusting event. The other non-adjusting event are basically those which you don't need to adjust it as at the balance sheet date, but subsequently, if those events have happened and no indicators were there as at the balance sheet date, all you need to give a disclosure about those events to say these have happened subsequent to balance sheet date, and therefore we don't need to adjust any balances for that matter.
Okay. There is one more query that in the notes, should a company disclose the name of all related parties of the entity or only of the entities with whom the transactions have taken place? So, because in many balance sheets, we see the list of all the related parties which are given. And in some of the balance sheets, which we see only the parties with whom the transactions take place. So which is the correct posture?
So the point is ki if you look at the standard, wherever the control exists, you definitely need to give the name of those parties, irrespective whether with those parties you have transaction or not. That's a step number one. Step number two is, if you are not having an entity where your control is there, which means all other parties, whether it is fellow subsidiaries or any other related party, for that you only give the name when there's a transaction. If there is no transaction, then there is no requirement to give the disclosure of those related parties.
Okay, thank you. It's very, very important, sir. Thank you very much.
Yeah, I think one other point which I missed speaking in my session is, many a times there are transactions with related party which people tend to combine it together and not show it separately because of sensitivities, and we've seen that many cases. The standard is very clear that if you have 4 different categories of transactions, purchase of goods, sales of goods, royalty, or any other transaction, and you have different parties against which these transactions have happened, then for each category, if a party is doing a transaction worth 10% or more, then that party has to be shown separately. You simply cannot bury that by saying other parties. So that's an important thing we need to keep in mind.
Any more questions from the audience?
Sanjay, one question. Why do we show dividend paid as related party transaction? Because it is per se a transaction between the company and shareholders. There is no transaction as such, but why dividend paid is required to be shown?
So the point is that if you are having an investor, which means there's a holding company, that holding company is a related party. If party exists, then any transaction that you're entering with the party has to be also disclosed.
Actually, it is per se not a transaction. Dividend is paid to all the shareholders in the same proportion as the company declares. So per se, it is not a what you call a transaction within the meaning of related party transaction, which can be abusive or anti-abusive of that sort. Right. So it is per se a transaction with all parties, and it is not at all a transaction, but it is a declaration, a ritual of declaration of profits, distribution of profits by the company to its members.
Yeah, so I'll tell you the reason why that is coming up is because we've seen that standard doesn't exclude whether if you are having a common transaction with one related party and many non-related party, under this kind of a equation, if you don't disclose a related party transaction, then you are effectively not giving a right picture. You may have the similar transaction with others. Like for example, sale of goods happens with others also. And if your company happens to be one of the party, it is again all in arm's length. But the fact that this is with related party has to come out.
Okay.
Sir, one more thing I would like you to throw some light on the prior period items.
Yes.
Because you see in the balance sheet, we see in none of the balance sheets of the general company, we see any prior period items. Nobody discloses there. What can be the reason? And another thing is which I would like to know is, there are definitely sometimes there may be instance of the prior period items, specifically in respect of the claims, which are pertaining to 3 years, 4 years back, which has been received or which has been paid during the year. So how should we treat it as a prior period item, or should it be treated as a prior period item only when the obligation to pay was there in the earlier years, or how we should look into this aspect?
Absolutely good point, Pramodji. Point is, it's a judgmental matter, right? You have to look at the sequence of event that has happened to be comfortable that really there was enough and more trigger in the past for you to record a claim, right? For example, if you've been fighting a case, right? So far in the past, you have been comfortable, you have a legal opinion in hand to say your case is a strong case, you will not end up into a liability, right? When you are actually recording a prior period expense. If you are having everything to prove that I had nothing contrary to record an expense, and in the 3rd year or 4th year you finally lose the case because something else has developed, then clearly one will say that no, this will not be a prior period because I have no reason to believe in the past. Similarly, if you have a customer receivable, or if you have a receivable from government authorities, which you have technically not recorded as an asset in the past as a receivable because government is so uncertain to repay some of these receivables, you end up into a cash basis accounting, right? So therefore, you will have all reasons to say that I have no history of past receipt of these claims from the government. Therefore, I took a conservative view to never set up a receivable. Suddenly, I've got it. Government has been kind to repay my service tax due. That's fine. I cannot call this as a prior period. So, huge amount of judgment is required. One has to look at it on a case by case basis. But clearly, it is no one size fits for all.
Thank you. But sir, in case of many say FMCG companies, which we see, like we are doing some audits of the distributors, there the FMCG companies, they account for the claim on the payment basis. Say the claims of the February or March year, and that is being paid by them in the next year, and they account for in the year in which it is being paid. So whether this will be treated as a prior period or it is just in the normal course of business.
So these are payments made to whom, sir? If you can tell me who
payment by the FMCG companies to their distributors. Distributors lost the claim in the month of March, but the companies make the payment in the month of April or May or June, and at that time they deducted TDS. So naturally they are accounting in the next year, but their obligation to make payment is always in the March.
Absolutely. So I will tell you, sir, in this case, how one needs to deal with it. If you have a contractual obligation that if they have submitted the bills for their claim before March, the company is supposed to make the best estimate of how much potential they will pay. So obviously, many claims they will make for 100 rupees, but you will end up paying only 60 rupees. But that does not trigger for you to defer the payment or a liability accounting in the next year. You have to make the best estimate and account now, because there is a trigger. The computation or the accuracy of the amount can be trued up in the later period, but not recording today is a prior period, certainly a prior period.
Thank you, sir.
Sure.
Any more questions from the audience?
Yeah, I would love to have questions on practical errors that we've seen or difficult situations that client face.
There is one query on the chat box.
Sure.
VAT on liquor is levied after balance sheet date. VAT on liquor is levied after balance sheet date, i.e. 31/3/2020, as per the decision taken after balance sheet date by the government on the goods in stock, as on 31st March. Whether the same can be accounted for in the year 1920.
Very debatable question, to be honest. I think this has to be also looked at from an enacted and substantively enacted angle. While substantively enacted is a deferred tax standard, but that is a concept one would apply, that has it been passed by the parliament, or is it just a clarification whether the circumstances existed as of the balance sheet date that such and such notification is likely to come. I think one needs to look at all of that. If it is something to say that it was already enacted and subsequent event is only a notification that comes in my mind, one has to true up as of the balance sheet date itself.
Any more questions from the audience? I don't have any more questions here now. So should we terminate the session now?
Yeah, I'm happy to take on if there are any questions, but if there is none, then we are good.
I don't think there is no query in the chat box.
Okay.
So thank you, Sanjay ji, for such a nice deliberation and a very, very detailed discussions which you had, and we have taken on all the queries, and I think all the participants here must have been hugely benefited by all the queries necessary that you have made. Sure. And I think that we from Calcutta have heard you. And
yes,
very
I'm from
interesting session. With this, I have a huge round of request everybody to have a huge round of applause for you for this session. Thank you so very much. And
thank you very much.
A message for all the delegates that we are going to have again a very good session tomorrow. Tomorrow, in the first session, we will have Schedule 3 here. Dr. Devashish Mitra will speak on the matter. And in the second session, we have again a speaker from Bangalore, Mr. Alok Saraf. Yes. He will speak on the 5 standards. Again, very, very important standards he will be speaking. So I will request everybody to join tomorrow also at the same time. Thank you, sir.
Thank you very much, and have a good evening. Thank you very much. My pleasure for coming on and speaking. Thank you.
Thank you, sir. Thank you.